how are you looking at the market environment? There are so many people who look at the headlines, the unemployment numbers. We're going to get unemployment claims literally in 15 minutes from now or 10 minutes from now. And then they look at the stock market and they say there feels like there's a disconnect and they're trying to make sense of it.
Yeah, so for CalPERS, we're certainly a longer-term investor. We pay attention to longer-term trends more than we do to any type of short-term shocks. But when you're a system that isn't fully funded, you also have to pay attention to the short term. And so this volatility has certainly been elevated. Our entire investment team has been playing this both a defensive posture, having a defensive posture. But, this time, as it relates to the downturn related to this health pandemic, versus how the fund was positioned and the health of the fund in 2008 and 2009, we're actually able to deploy some offensive strategies as well. So that's been optimistic, but we do worry. We worry because if we don't hit our 7% return target, obviously that puts more responsibility on our public employers to have to pay more. So we do pay attention to it, but we're really careful about not overreacting and really thinking about the long term and how these trends will really impact the various asset classes across the portfolio and where those opportunities might exist in the future.
So tell us where those opportunities might exist then. What trends are you going to see, you think, going forward?
Yeah, so one of the things that we were able to do, if you think about, again, CalPERS not being completely fully funded, drawdown risk and risk mitigation was certainly one of the top three priorities for the investment office. And we were able to set up some distress triggers, if you will. So certain points in the market, we would be able to deploy capital appropriately through a couple of very strong business partners. Those capital calls are coming in, and those will have nice payoffs for the fund over the long term. So that would be, one of the opportunities that we would see. As far as the asset classes, we certainly want to look at commercial real estate. We're tracking the unemployment rates. There will be trends coming out of this pandemic, having the markets react in the way that they have to a health-related item that then impacts the economy and then impacts the financial markets. But one of the things we do want to applaud is the Federal Reserve. We have to applaud their efforts. It's unprecedented, but they've been very helpful in keeping the financial markets working.
All right. Marcie, I wanted to ask you a question. We were talking about CalPERS on the air earlier this week. We had Universal Investment scientific advisor and Black Swan author Nassim Taleb on the program, and he was critical of CalPERS' decision to unwind a tail hedge strategy last year. And I just wanted you to hear what he had to say and react to it.
The universal hedge that would have made you $11 billion would have cost you a penny, or something that would cost you $30 million in an adverse situation would have made you a huge multiple of that. So I think he insulted not just the public, but he insulted the retirees who are invested and depend on CalPERS for their future income.
We don't want to
react to that and speak to it.
Yes, certainly. I don't really, necessarily, want to debate this. We think these products work very well for many investors. But the decision that was made by CalPERS back in October was one that was more related to looking at the total fund, the utility of our investment office, what we're good at, what we're capable of. And really back to that, our concern was drawdown risk. Our concern was that this fund, coming into the downturn, we were roughly 73% funded, but we have asymmetrical risk. The downside is going to hurt us more than the upside. So the risk mitigation was really around two areas: factor-weighted equities, which we've been putting in place for the last couple of years. About 15% of the portfolio is in factor-weighted equities now. And then long-duration treasuries. And we have about 10% of the portfolio in long-duration treasuries. But those were what we were using to hedge. And I have to say, through this volatility, we have been advantaged by about $11 billion with those strategies.
Final question. You've been a big proponent of ESG, and I'm wondering whether it's more or less important than ever before right now, and how you think it changes the dynamic for you.
I think it's extremely important. I don't believe we will change our view on the importance of governance on the various boards and the companies that we're investing in. Proxy season obviously is coming up. We are very encouraged by what we're seeing, but we will continue our emphasis on board diversity. We'll continue our emphasis on risk management, and that includes risk related to climate. It includes risk related to supply chain. I think this pandemic has certainly highlighted some issues around the supply chain that consumers are concerned about, consumers as well as investors like CalPERS. So we will keep our focus on governance. We'll keep our focus on climate-related financial disclosures. Our TCFD report will be coming out in a few months. And we think that these are important to the fund, that we have to understand the long-term risk, situate the portfolio appropriately.